Hi everyone, this is Paul Fichet, Chief Investment Officer at Neuro Capital, giving you your February market update. So a phenomenal month for risk assets again, with the all share up 7% for the month, and mostly driven by platinum and gold companies. Developed market equities up 0.8%, and then emerging market equities up 5.5%. So all in all, the rally in February vastly dominated by your emerging markets, including South Africa, but developed market equities still holding up very well as well. If we look at US inflation, it came in at 2.4% annualized in February versus the previous number of 2.7% and an expected number of 2.5%. So a downside surprise and reduced inflation from the previous month. And that just ties into our thesis that you're going to continue to see muted inflation in the US. And we've been saying for a while, you're not going to see raised inflation there. And this just kind of deepens that thesis. And we think just ultimately very good for the economy there. It's going to lead to further interest rate cuts and also just open that economy up nicely as well. If you look at South African inflation, up 3.5% for the month, slightly above target, but still we think under control. And you'll probably continue to see rate cuts in South Africa as well over the course of this year. So all in all, very bullish on the interest rate and inflation side. If we look at the rand dollar, the rand strengthened against the dollar on the back of this obviously risk on month. Started at about just north of 16.10 to the dollar and ended at just north of 15.90. Tying into the bonds, South African bonds still on a SA-US 10-year bond spread. You're still looking at north of 4%, the difference between our yields and the US yields. And that translating nicely into real yields in South Africa still on your longer end of between 5 and 6%. So that's yields above inflation of between 5 and 6%. So we're still very bullish on SA bonds. We have been bullish on them for a while, and they've done very well with us, or were very well for us, and we continue to hold them. We think they'll continue to do well. The ALBI, the local all bond index, returning 1.7% for the month, so very good return for the bonds. And then if we look at international bonds, the G7 bond index, that's your biggest 7 economies, up about 1.3% for the month. And then the US long-term bonds up just north of 4.5% for the month. If you've been listening to my voice notes, you'll know that we are quite bullish on those long-term US Treasuries. We have been buying into weakness over the last few months, and really that investment is starting to pay off nicely for us. So that is a phenomenal return for those long-term bonds for the month of February, and we continue to hold those as well. We think that you'll see a similar story there as that you saw with SA bonds over the last few years. So kind of bonds oversold, but recovering quite nicely and becoming actually turning out to be a very good investment. So very happy with that. The funds have held up very well in February. Just a note on the turmoil in the Middle East. So we've seen a fairly muted reaction over the weekend. So today the all share down about 30 basis points. So very muted in terms of what's going on in the market, kind of in line with what you would see on a normal day. So local shares not really reacting. If we see futures in the US down about 1%, so you potentially see 1 or 2 days of volatility there, but nothing sort of out of the ordinary. The response has been fairly muted. The big reaction, probably the gold price. So gold has rallied $5 to $10 in the last few days. We actually would have thought on the back of something like this that you would have seen a bigger rally there, but still fairly muted. So, we think that probably you'll see a short-term reaction in the markets, but nothing big, nothing to worry about. It doesn't change our thesis. We're still looking kind of long-term at the economics. And if you look at the earnings cycle, that's just finished in the US, fourth quarter of 2025 just been announced over the last few weeks, and earnings still looking very good in the US and beating expectations. So we continue to look at the economics, and we remain bullish, obviously watching the markets, making sure we manage our risk, but at the end of the day, also not being too risk averse and just managing our portfolios efficiently and effectively. So all in all, very bullish still, and we like what we see in front of us and the runway that we have in front of us. As always, if you need anything, please don't hesitate to contact myself or the team. Otherwise, we will chat to you in April with your March market update. Take care. Bye.